Hi, let's take a look at the real estate investment term cash flow.
Investment real estate terminology. Real estate licensees will be asked by potential investors for guidance in choosing investment property. To work with investors, licensees need a good understanding of how to measure the financial performance of investment property. With residential property, you will find investors that are looking to either rent the property or do a fix and flip. On the selling side of a fix and flip, especially in the retail market, there's already room calculated in the selling price by the investor for your commission. Their objective is in getting the property sold as quickly as possible so that they can fund the next project. These investors will want a market knowledgeable real estate agent with great marketing reach. One of the exciting aspects about being adept at working with investors is that these individuals will usually keep coming back to you to purchase or sell more properties. However, just as the potential rewards have increased to you, so has the potential for liability. Working with aggressive investors on both ends of the deal, locating and buying properties, as well as the listing and sale of the improved property. To prepare to work in this specialty, start by understanding basic investment terminology. Cash flow. Cash flow is income minus deductions for expenses, including the cost to repay the mortgage debt and income taxes. Positive cash flow is created when there is money left over after the deductions. Negative cash flow is when the income doesn't cover all the expenses. To calculate cash flow, take total annual income and subtract operating costs and the debt payment. Included as an expense is the cost of property taxes and insurance. Maintenance and ongoing expenses to improve the property are also subtracted. So income minus expenses, including property and income taxes, insurance, mortgage, debt payment, and improvements made, equal cash flow. Cash flow is king. The whole point of investing in real estate is to generate income. Your cash flow is defined as the remaining income after you deduct expenses and debt repayment from the income generated from the investment. The resulting cash flow can either be positive, meaning you are making money, or negative, meaning you are losing money. There is a saying among investors that cash flow is king. Experienced real estate investors generally buy properties that are cash flow positive, based on conservative estimates, not perfect world estimates, and skip potentially negative cash flow properties. Again, to calculate cash flow, take total annual income and subtract the operating costs, the payments for the debt, such as mortgage, property taxes and insurance, and cost to maintain or improve the property. The remaining amount is your annual cash flow. Note, this is not the same formula that is used to calculate net operating income. Cash flow story problem. Lonnie purchased property with a total rental income of $30,000. He paid a property management company $4,500 to handle the rental clients. He paid $8,000 total for property insurance and taxes combined, $5,000 in miscellaneous repairs and expenses, and paid $10,080 for principal and interest payments. What was his year-end cash flow based on the figures provided? Cash flow solution. Cash flow is income minus deductions for expenses, including the cost to repay the mortgage debt and income taxes. Income minus expenses equals cash flow. So we have $30,000 in income, and we subtract the $4,500 paid for the property management fees, the $8,000 paid for insurance and taxes, the $5,000 in miscellaneous fees, and the $10,080 paid towards principal and interest, which leaves us $2,420 in cash flow.